Good day to you. In Australia, we should say good day. It may be
Good
good
day.
morning,
Good
good
day.
afternoon, and good evening.
Yes,
Good day, mate. Good day, mate. Good day, mate.
exactly right.
Yeah. So this webinar is organized by our FIABCI World Council of Experts. You may know that FIABCI is the World Federation of Real Estate, International Real Estate Federation, based in Paris, and we have around 75 countries in the chapters. Thailand is also one of the chapters, but here we organize under the FIABCI World Council of Experts. I'm the president of this council. FIABCI, we have different councils. Say we have council of developers, council of brokers, council of property managers, council of proptech, and council of some other council as well, council of architect and council of valuers. Actually, I'm also a valuers. I should be in that council as well. So for us who may know FIABCI, maybe you can join FIABCI through your chapters in your countries. In Thailand, and also the president of FIABCI Thailand. So anyone who are in Thai, you can be our members. And you can also join our international events. Normally, we have in March in Cannes, in France, we have the largest real estate exhibition of real estate there in Cannes every year. And in May or sometimes in June, we have our World Congress in real estate. I just came back from Nigeria. It was organized in Nigeria during June 8 to 13. And then in September, we also have our real estate trip. This year will be in Roma, in September. And December, we have another event that is the FIABCI Global Leadership Summit. And this time will be in Panama City. Panama City is really open for Thai, like me. No need to have visa. I think for most of the countries in Thailand, in the world, you can go without any visa. So you may kindly join our event 4 times a year. So this is what happened. And next year, FIABCI World Congress in June will be in Vienna, Austria. So you should join us. That is a really beautiful city in Vienna. Okay, but today we will have our webinar. This time will be on business valuation. We organize this sort of webinar every month. So you can go to our FIABCI Thai website. In the FIABCI Thai website, there were many authors webinars every month. You can go there and you can download the files like PowerPoint files and also the video in YouTube. You can find it there. There are so many good sessions that you should have a look. So this is what happened in our FIABCI World Council of Experts. We also have many other councils that have a lot of affiliate activity. So if you are our members, you can join any session online or also offline or maybe face-to-face. Okay, today we will have our session on this coming business valuation. And you may know that our speakers, here's my great friend indeed. He is a great valuer from Australia. I will let Mr. Gino Mitrione to introduce himself. But so far as I know in my experiences that he really great valuers, and he also study mass appraisal at the International Association of Assessing Officers. I have been members for over 20 years as well. And we went to Uganda a few years ago before COVID to teach valuation of mass appraisal for 2 full weeks in Uganda there. And sometimes he also come to Thailand to teach mass appraisal as well. So that is his international experience. And now he has also his own firm in business valuation and valuation of real estate as well. So Mr. Gino Mitrione, maybe you can kindly introduce yourself and start your session. So the floor is yours, please.
Thank you, Dr. Sopon. Thank you for that introduction, and thank you for allowing me to present this afternoon's topic of how to value businesses. So I might start with sharing my screen. Hopefully you'll be able to see this now. So just a quick introduction to myself, just so you're aware of my background. I'm a fellow of the Australian Property Institute. I'm a certified practicing valuer, have been for over 40 years in Australia. And also a University of Melbourne lecturer in valuations. I've been teaching there for nearly 15 years. And I am also a member of what's called the Victorian Civil Administrative Tribunal here in Victoria, where we hear valuation disputes. So I'm able to make decisions when there's a valuation dispute. So I've got reasonable background in valuations. I've known Dr. Sopon now for more than a decade, and as he has stated earlier, we've worked together in numerous capacities. The most interesting was when we spent 2 weeks in Uganda teaching valuers their mass valuation processes. Most of my background is in rating and taxing valuations here in Australia. And I've been doing that for many, many years using multiple regression and the use of computer systems to do valuations of hundreds of thousands of properties in a short amount of time. But today, Dr. Sopon asked me if I could give a presentation on the valuation of businesses. And it's quite a complex process to value a business. There's not a lot of written material on how to value businesses, not in the same way as valuing houses or factories or shops. Lots of books and literature on how to do valuations of real estate, but there's not a lot on how to do valuations of businesses. So I thought I'd give you the benefit of my experience, and I think the best way to go through this presentation, if anybody has any questions, don't be afraid to raise your hand and we can discuss a matter directly rather than waiting on the end, but up to you. But I welcome questions throughout my presentation. Okay, so let's start. Okay, how do you value a business? Well, again, not an easy process because like real estate, businesses take all different types of forms. So very difficult to have a standard format as to how to value a particular business. But these are some of the questions you should be asking when you're going to start a valuation of a business. What type of business is it for a start? Sounds an obvious question, but you need to have a full description of the type of business that you're looking to value. And is that particular business a standard type of business or common type of business, or is it quite unusual? I did a valuation of a business recently that sold kitchenware solely through the internet. So something quite different in that valuation of a business as compared to, say, a coffee shop, a cafe, a restaurant, reception centre, service business like an accountancy practice. They're all what I would classify as standard types of businesses. And a lot easier to value because there's a lot more evidence of the sales of those types of business. But when you have a business that you're required to value that is not quite standard or common type, then becomes even more difficult process. But again, it's important to understand that distinction. Is it a standard or common type of business, or is it a very specialised type of business? Another question that you need to ask is, how old is the business? How long has the business been running? Is it an established business, or is it a startup business? Much more difficult to value a startup business than clearly an established business, obviously simply because of the records that you're able to examine, financial statements, historic performance of that business. Always easier to value a business where you can look backwards and examine the financial statements as to how it's been trading rather than a startup. I was asked to value a business last year, a startup business that was using very clever base and service that they were offering. It was a credit card, a business that offered credit cards, so nothing different there, but it was tied to the value of gold, the international value of gold. And I thought that was quite an interesting business, but it was a startup and they hadn't quite started trading, but they wanted me to do a valuation of that business, which was extremely difficult without any information or any historic records to base that on. So the age of the business is quite an important aspect when doing a valuation. The next question you need to ask is also how many owners or staff are directly working in that business. That's extremely important to know. How many people are working in that business and how many of the owners are also working at the business, because that means they're all being paid a salary and you need to be aware whether those salaries are market based or not. So number of people working, and that's either full-time or part-time. So that's an important aspect to know as well. The next one is, does the business operate from a premises? So is it working out of a property or number of properties? And if it is, are there formal leases in place? And what do those leases allow for that business to operate at that particular property? That's important to know because of the tenure. The length of the lease is an important aspect, but also the use that the lease allows. Is the business using the premises in line with both the lease and if required the permit? Is there a permit in place also that allows that use? They're important aspects to know. Another point, and I know that a lot of professionals who work in business valuations don't necessarily use this next item that I've listed, but are there likely to be sales of similar type of businesses? Now, because the sale of businesses are extremely difficult to research, I know that a lot of professionals in Australia don't rely on sales evidence to value businesses. They more take a forensic or an accountant view of a business and just multiply the net profit by a particular margin. But I think a valuation of a business must rely on comparable sales of similar types of businesses. If you haven't got that information, then you're really taking a guess at what the business is potentially valued at. So you need that sales information of similar types of business that have sold recently that you can make a comparison to. And the next question you need to be familiar with is the purpose for the valuation. Why have you been asked to undertake the valuation of this particular business? That's also a critical point in understanding what your valuation is going to be used for. Some other questions that you should be asking about the particular business that you're valuing, doing a valuation for. What are the barriers to entry of this particular business? Is it easy to get into this sort of industry, or is it difficult? The legislative requirements is one aspect, but also the cost. What does it cost to actually commence this type of business? Does it require large amounts of investment to buy plant and machinery, or is it relatively cheap and anyone can set up that particular type of business? So that's an important question to understand the answer to. Also, what is the risk profile of the business? And what I'm talking about there is if someone purchases that particular business that you're doing a valuation for, is it likely to continue in the way that it has performed in the last number of years? So that's what I'm talking about, risk profile. You need to make almost a measurement of that aspect and measure that risk profile of that particular business. As I stated earlier, the next question you need to ask is this an established business? Is it a startup or is it a fully established business? Quite different aspects of that answer that you need to then apply in the valuation process. How unique is this business? Is it different or is it a standard type of business? The answers to those questions could make the task either easier or more difficult, depending on the type of business that we're talking about. I mentioned the risk profile of the business, but also the risk profile of the industry is also an important aspect to fully understand. So not only are you doing research on that particular business, but also on the industry. The business that you're valuing can have a really solid track record of the last number of years, but it's in an industry that's actually going through some difficult times. So you need to take that into account as well. The location, if it's operating from a premises, the location of the business is important. Is it in a remote area? Is it in a rural area, provincial town, or is it in a city or a major city? They're all important questions to know and understand how that location impacts on that particular business and the likelihood of it being an attractive proposition for a potential purchaser. What is the likely buyer demand for this type of business? Is there likely to be a lot of people wanting to buy this particular type of business, or is it very unique and there would be limited number of buyers? Obviously, that has an impact on the end value that you might determine on this particular business. Which clients are responsible for the largest percentage of revenue? Extremely important to understand where the business makes their revenue from. Is it one particular client giving a large percentage of the total revenue? If one client is providing more than, say, 50%, you need to understand that and be able to apply that in a valuation sense. Or is the revenue obtained from many clients across the board? There are advantages and disadvantages to both sides of those answers. But again, you need to understand, if you're doing a valuation of a particular business, where the revenue is coming from, which are the major clients providing a large percentage of the gross income. As I said earlier, purpose for the valuation, extremely important to fully understand. Why are they going to use your valuation? And that will determine which end of the range spectrum you might sit at. Like a property valuation, we always have a range, and depending on the purpose for the valuation, we might sit towards the bottom end or the upper end of that range. Same thing with a business. Depending on what they're going to use the valuation for, you might sit within one end of that range of value. I also did a quick look on the Australian Property Institute website, which is linked to the International Valuation Standard, and there's a lot of information in the International Valuation Standards that have been rewritten just recently. I think towards the end of last year, they rewrote the last version. And there's a lot of information on there on valuations of businesses, but I thought I'd clip this particular definition, which talks about operating and non-operating assets. The valuation of an ownership interest in a business is only relevant in the context of the financial position of the business at a point in time, and which ones are redundant. Sorry, at a point in time, the valuer should determine which items are required for use in the operations of the business and which ones are redundant or excessive to the business at a valuation date. Most valuation methods do not capture the value of assets and or liabilities that are not required for the operation of the business. I thought that was an important definition that they talked about in the International Valuation Standards. I did a valuation recently of a crane hiring business, which hires out cranes for various companies to use. And what this company was doing was purchasing these cranes and then hiring them out. And as you can appreciate, the cost of purchasing the cranes was very excessive. And whilst I had to value the business on that basis, I made a comment in there that I thought the business would operate at a much profitable level if it clearly just leased plant machinery out rather than purchasing it outright. And that business was quite profitable anyway, but the profit levels would substantially increase if it just took that different view. So I thought that was an important term to quote for this afternoon's presentation. So how did I get started in valuation of businesses? Well, it happened way back in the 1980s, which I think a lot of you might not even have been born at that point in time. And this was a Supreme Court case in Victoria that I was centrally involved in. Now, I said earlier that there's not a lot of written material in Australia and probably across the world in how to value businesses. But in Australia in particular, there's a lot of information and assistance in how to value businesses in court decisions. And most of the court cases in Australia that involve the value of how to value businesses is in the compensation field, when businesses as well as properties are compulsorily taken by the government for construction of roads, schools, hospitals, all those types of public infrastructure. And I was involved in this court case in the 1980s between Ramsdale, who owned a takeaway food premises on a very busy road in the northern suburbs of Melbourne, and the Roads Corporation, who compulsorily acquired the property and the business to construct a freeway. And this court case really set to me the base of how to value specific businesses. This was a decision that came out in 1992, so a long time ago. This decision was by Justice Gobbo, who's very famous in Australia for writing decisions in relation to valuation of property and businesses. So I'll just go through some of the points this case was about, and hopefully you might gain some information, valuable information on the valuation of businesses. So the premises on which a takeaway food business was conducted was resumed, compulsory acquired for public purpose. The owner had secured a planning permit in 1983 to erect a food premises on the subject land, which was reserved under the planning scheme for a main road. The permit contained the condition that the use hereby permitted may be terminated by the responsible authority delivering to the owner or occupier of the subject land at any time after the 30th of October 1993. Notice in writing requiring the termination. The premises was leased in 1983 for a period of 10 years with an option for a further 3 years with power to terminate on notice after October 1993. So what does that mean? This particular business had two things that were negative in relation to claiming compensation for compulsory acquisition. The first was the permit was expired just as the property was going to be acquired. And the lease also said as a special condition that the tenant cannot claim compensation. So there were two things that worked against the business owner claiming compensation against the government. The lease contained an acknowledgement of notice of the road widening proposal affecting the land and acknowledgement by the lessee that they had no claim for compensation in the event of resumption or acquisition. The authority argued that the effect of the planning permit was that the claimant's interest in the land did not extend beyond the 30th of October 1993, and at any rate should be treated as having no value beyond that date. There was considerable dispute about the calculation of the compensation for the loss of the business. The main claim was for $400,000 for the value of the takeaway food business, which I was arguing as expert witness for the owner of the business. This was eventually put forward as a claim for $388,800. The authority offered the sum of $256,000 for this item. Its expert witnesses assessed the value of the business taken at $256,500. Now I'm just going to go through the decision that came out of the Supreme Court on this particular matter. And this was part of the judgment that Justice Gobbo had written. The provision in the lease does not define the extent of the interest, but is concerned with excluding any claim for compensation against the lessor in the event of an acquisition before the end of the term. Secondly, the critical clause in the permit does not define the life of the permit, which runs with the land and is indefinite. It merely says that the use may be terminated by the notice or after the 30th October 1993. It does not say that the permit must come to an end at that date. It is quite open that the permit may not be terminated at all, or that it may be terminated long after October 1993. So in both instances, in relation to the permit and the lease, the judge said that did not affect a claim for compensation for the loss of this particular business. Justice Gobbo went on to say, I'm accordingly of the view that in assessing compensation, the proper approach is to treat the interest as being one of a leasehold term of 10 years, and that the option of a further 5 years was also relevant to the matter of the extent of the interest. So he was saying, in his view, this business should be viewed at as having a 10-year lease with a 5-year option. It was clear that the subject business was ideally located for a business of its type, and it had a record of proven takings against substantial opposition, fast food outlets such as Kentucky Fried, McDonald's, Denny's and Hungry Jack's. The gross takings averaged $14,400 per week in the last year before acquisition. The figure for sales averaged over the last 3 years was $13,500 per week. It is also substantially common ground that the evidence certainly established that fast food outlets such as the subject business were bought and sold by reference to gross weekly takings. That's extremely important. So the judge was saying that these businesses are purchased in the marketplace based on their gross weekly takings, usually warranted over a 3-year period and then multiplied by a multiplier that reflected the further potential or other special factors. These were some of the sales that I'd put forward in arguing the value of the subject business. So the prices were, for one particular business, sale number one sold for $259,000, and they had gross weekly takings of $9,000, which resulted in a multiplier of 30. The second business sold for $295,000 and had gross weekly takings of $10,500, a multiplying factor of 28. Tullamarine, $395,000, 22,000 weekly takings, a multiplier of 18 or 20.5, depending on how you analysed it. Another business sold for $210,000 with 11,000 gross weekly takings, multiplier factor of 19. And another business there was quoted as having a sale price of $298,000 for $10,000 gross weekly takings, a multiplier of 30. So there were some of the sales of comparable type businesses that we presented to the court. Again, Justice Gobbo, examining those sales, said the following: on balance, I am left more persuaded by the traditional approach to the valuation of a business he was talking to. I accept this view that the lower takings sales help to set a minimum for the subject property, he meant business in that case, of 300,000. There's more difficulty about the upper limit. This depended on both the takings and the multiplier. The proper approach, in my view, is to use the method indicated by the market. Again, that's an extremely important comment in his judgment, which was based on 3 years' takings, but to use the multiplier to reflect the special or added potential of the business reflected by all the material. Included in this material was a clear surge in takings in the last year. Also to be added here were the locational advantages of the subject premises and the improvement in takings in spite of the long history of intense competition. It is appropriate in these circumstances to adopt an assessment with suitable modifications, which leads to the conclusion that the value of the business at the relevant time was one based on takings of 13,500 per week, but with a multiplier of 24, resulting in a total figure of 324,000. So that was his assessment of the subject business. I note in passing that neither expert made any reference to the sale of the subject business in November 96 for the sum of 300,000. Of course, this was too remote in time to use as a comparable sale, but it is interesting that on the takings figures for 86, 87, the multiplier shown by such a price was 24. It follows that the compensation payable for disturbance loss, being the divestment of the claimant's interest in the property, is 324,000, being the value of the interest being divested. It is not necessary to do so, but I find that the same compensation should be recoverable as special value. So that was the first court case that I was involved in, and that gave a pretty good base as to how to undertake a business valuation. And this particular business was a standard takeaway food premises specialised in the sale of chickens, and the Supreme Court in Victoria said the best way to value that is the same way that's valued in the open market. What someone would value that business in their own mind in putting an offer to purchase, and that was based on gross weekly takings. So a very simple business and a very simple approach into how to value them. But the decision that came out of this court case, which said to value a business of this type, you need to look at the market and see what the market does. And that's a good sound base for valuing any business. How does the market view the value of that particular business? How does it work out the value of those businesses? And then apply that from a valuation point of view. So as I said earlier, a lot of the material in relation to how to value businesses really comes out of court cases based on compulsory acquisition, when different levels of government compulsorily acquire a property where a business is operating in. So a lot of the material I'm going to go through in the next few minutes really comes out of court cases that involve governments acquiring particular businesses. So this first comment, when premises used for business purposes are compulsory acquired, loss of business goodwill, and most of the businesses have the business goodwill, that's what we're valuing, may be suffered by the occupier, whether they are the owner or the lessee. In Loddon County Council versus Tobin, a 1959 court case here in Australia, the courts ascertained that the method in assessing business goodwill was to value the business in the old premises immediately before the transfer, then the capital value of the business in the new premises, and then compare the two. So that's more about when a business has to move locations because of the compulsory acquisition. The valuation of a business as a going concern, including any attached goodwill, is required where the taking of premises results in the cessation of the business because of its complete dependence upon the site occupied and the unavailability of other suitable premises. where a business is conducted in when a business is conducted in premises held under lease, the valuation of the business goodwill must take into account the length of the unexpired term of the lease, any additional terms, and all the expectation of any renewal had the acquisition not occurred. Now, that's a really important point to fully understand when valuing any business that operates from a particular property. How long is the lease allowing that use to continue? If a particular business has a lease for a short term only, then that makes it very difficult to arrive at a substantial value for that business. Because for any business to continue, it really does need a long lease to allow that occupation of that particular property. Where the acquisition does not cause termination of the business, any goodwill attached to it is required to be valued so that any reduction in its value in its new location may be measured. Another court case, this goes back way to 1901, in Inland Revenue Commissioners versus Muller Limited. Goodwill described as being the benefit and advantage of the good name, reputation, and connection of a business. It is the attractive force which brings in custom. It is the one thing which distinguishes an old established business from a new business at its first start. Goodwill can be classified as either local or site goodwill or personal goodwill. And it's important for you to understand the distinction between those when valuing a business. Does that particular business trade well because of the owner-operator having a good reputation? And most people come to that particular business because of that particular person. Or is it more the services that are being offered? So important to understand that distinction. With the exception of Western Australia, none of the compensation provisions makes any direct reference to business. In ordinary circumstances, a claim for business losses which are due to the acquisition fall under the heading of disturbance, and that's just for a compensation point of view. If we look at the methods of valuing businesses, most of the literature around classifies the valuation methodologies into 5 different formats. And these are methods of valuing goodwill. There is no single globally accepted convention regarding a valuation methodology. However, there are several identifiable valuation techniques. And these are conventional or trader's method. That's the most standard for small businesses in particular. We also note that discounted cash flow analysis is being used more and more to value businesses. The capitalisation of future maintainable earnings is also another method. Asset-backed valuations, where a particular business owns many assets. It's more concentrating on the assets more than the business operations itself. And the capitalisation of future maintainable dividends for those larger organisations, larger businesses. So let's go through each of these in a more close format. So conventional or trader's method, this is more the approach that I mentioned earlier in the compensation for the business that was compulsory required earlier in the Supreme Court by Justice Gobbo and his decision. Primarily used for small businesses and based on the number of units sold in that type of business. For example, if it's a bakery, the number of loaves, bread loaves sold, or the number of newspapers for a news agencies, for example. With the use of comparable sales, we can multiply the net maintainable profit by an appropriate factor. So this method would be ideal for valuing cafes, restaurants, those food type businesses. So for example, here we have a coffee shop within a shopping centre might have the following annual figures over the past 3 years. Annual gross takings, let's say they're at 300,000 gross income. the expenses, and this is a very basic approach. The annual expenses for this particular business is, say, around 200,000. So we have a net annual profit of roughly about 100,000. And if we look at the sale prices of these types of business, we see that they sell, generally speaking, for 2.5 times net profit. That's what our analysis shows. So we simply apply on the net annual profit here of $100,000, the multiplier of 2.5, which comes up to a value of 250,000. Very basic, very simple, and used to value small hospitality type businesses with secured leases and a proven track record of both the gross takings and also the expenses. Normally, these types of business have one owner operator and who are drawing a basic salary, but nothing outlandish. And these types of businesses operated for somewhere between 3 and 5 years and then sold on to the next operator to come in and try and improve the business. So very basic, very standard, and as I said, used to value businesses that are involved in the sale of food. And please don't hesitate to yell out any questions as we go along rather than waiting to the end. The next approach is the discounted cash flow techniques. Now, the problem with valuations in Australia in particular is whilst discounted cash flow analysis is used as a valuation technique, valuing real estate, all different types of real estate, hasn't been endorsed by the courts here in Australia. In fact, I don't know whether that process, that methodology has been approved by courts anywhere around the world. A lot of clients require discounted cash flow analysis to be used as a method of valuation because they would like to see how that particular method stacks up as a valuation tool. But the method itself has not yet been ratified by the courts, so that makes it a little bit difficult. But so long as you're aware of that, you can use that as a valuation technique, but probably not as your primary method of valuation, maybe a good supportive method. So discounted cash flow recognises that shareholders, and this is now specifically relating this valuation methodology to valuation of businesses, recognises that shareholders' returns comprise dividends plus capital gains from share price increases. This method also recognises economic cash flow. It also recognises the present value of money, allows for both the business risk, the nature of the industry in which the firm operates, and the financial risk, the extent to which debt funding is used to finance operations. So the beauty of discounted cash flow analysis, it looks at, on an item by basis, all of the revenue that's coming in and all of the expenses, in particular, the cost of plant and equipment, whether that's purchased or leased. So all of the debt is taken into account in the discounted cash flow technique. This method also allows for incremental changes to be made to capital as a result of the forecast business growth. So you're also not only taking into account the operations of the business today, which is based on how it's performed in the past, but also how it is or how you believe it is likely to perform into the future. A little bit of risk involved in that as well, because you're being asked to forecast the operations of that particular business. Again, intimate knowledge of that business is required for you to undertake a valuation using this methodology. But there you go. A discounted cash flow technique is certainly a method that is being used by practitioners today to value businesses of this type of nature. The next methodology is the capitalisation of future maintainable earnings. And And this method relies on a judgment as to what is a reasonable estimate of the future earnings of the business and capitalising at a rate reflected by a reasonable price or earnings ratio. This valuation approach requires two parameters: the earnings the company can sustain into the future and the rate of return that accepts those earnings. Again, you will need exceptional knowledge of the business to undertake this valuation methodology. You need to be able to forecast how that business is going to operate into the future, which is very difficult to do unless you have an intimate knowledge of the business and the industry and how that's going to perform. But you need to be extremely confident of how you believe that business will trade moving forward into the future. The next method is reasonably straightforward in that it's focused more on the assets that are owned by the business rather than the revenue, the trading, the performance. The asset-backed valuation approach, generally used in the following circumstances, where a company is not expected to remain as a going concern. The thing that attracts buyers to this type of business is the assets that it owns. It could be in property, it could be by way of contracts to undertake certain business performance, or relationships, where assets are of a prime importance to the company's operations and marketable in their own right. So that's the attraction, that's the focus of purchasers when they're looking at this particular type of business. There are three types of asset-backed valuation approaches: liquidation-based valuation, so what would happen in a fire sale sort of approach, and that's normally used to value the properties that the business actually owns. Orderly realisation of assets, so what would those assets sell for in a more orderly approach to selling those assets rather than a fire sort of situation where they're sold very quickly to find an owner at any cost. And the net tangible assets, what would they actually sell for in their own right in the open marketplace? So they're more concentrating on the assets rather than the operation and how the business actually performs. The next method, this is more for those larger types of organisations and companies. This is known as the capitalisation of future maintainable dividends. This method requires an assessment of likely future dividends based on maintainable earnings and the expected dividend payout rate and determination of a capitalisation rate. But as I said, they're more involved, this approach is more involved in larger organisations, multiple million-dollar organisations that have shares and dividends involved. So not sure of how many of you would undertake valuations of those sorts of businesses. I certainly haven't in my experience, but that's the method that's used to value those larger organisations. I thought I'd also quote a particular principle in Australia. I'm not sure if this is accepted worldwide, but it's it's known as the valuation of separate interests, and it's known as the Rosenbaum principle. It has been long recognised that and this is valuation of businesses in a compensation environment where property and businesses are compulsory taken by governments and a value has to be assigned for compensation purposes. It had been long recognised that the compulsory acquisition of land often involves the interests of more than one person. So we're talking about properties. A property that has a business operating it has multiple interests. You have the landowner interest and you have the interest of the business owner. So two separate interests in the one property that's being acquired. In the High Court of Australia, Justice Griffiths stated, in every case of a lease, the ownership of the land is divided between the lessor and the lessee. The value of the lessee's share in the total ownership is the value of the term. The residue represents the value of the reversion which remains in the lessor. So this is a very old court case in Australia, And basically it was saying when you value two interests in a property, one the real estate and the other being the business, there's a connection between the two. They're actually related. And this was believed for many, many years in Australia, and I think also across the world, until the Rosenbaum case was heard, which uh, the view that I've just expressed by Justice Griffith, this view was overturned in the proceedings in Rosenbaum's case, where it was established finally that the value of each separate interest or estate in land, which is resumed, must be ascertained by separate valuations. It follows that where the value of the various interests are separately ascertained, the sum of such values might well differ from the value of the unencumbered fee simple. So what does that mean in itself? It means that there's the view that the value of the property and the business for many, many years that was connected and related. Rosenbaum now said, no, that's not right. They're separate, entirely separate interests and have to be valued entirely separately. There is no connection between the two. So the valuation of a real estate is one process, and the valuation of business that operates on that same real estate is also a separate process. There is no connection between them. They are entirely separate. So the Rosenbaum principle is very important as valuers to understand that there is no connection between the value of the real estate and the value of the business that operates out of that real estate. So that's really important to understand when doing a valuation of a business. Okay, so just continuing a little bit and finishing off on the Rosenbaum principle. The Rosenbaum principle establishes that it should be decided upon the true construction of the Public Works Act 1912, New South Wales, each person or party having an estate or interest in the land, including a tenant, has a separate and independent claim to compensation for the value of the interest which is taken from him or her by the acquisition of land. The right to claim compensation is subject to each claimant establishing that he or her has an entitlement to an interest in the land. Each interest must be separately valued. The court is not concerned with questions of title, but is concerned with determining the nature of the interests of those entitled to compensation. And the court determining compensation would ordinarily have jurisdiction to determine the nature and the value of all interests. In other words, again, just reiterating, when valuing a business, there is no connection between the value of that business and the value of the real estate. They are entirely separate. Okay, so moving along now to, again, the type of information that you need to be aware of before you undertake evaluation of any business. Firstly, the gross revenue of the business. I mean, that's pretty standard to understand, but you need to know what the revenue is of that particular business. Now, what you'll find is there are two types of revenue, the revenue that the business operates in, and also there might be other types of revenue that the business earns. So you need to be aware of what they are and differentiate between the two. You also need to be aware of the cost of goods of that particular business. What are the cost of goods in operating that business, which will give you then the gross profit and the gross profit margin. You need to be aware of the extent of the cost of goods and whether that's particularly standard for that particular type of business. I did a valuation of a business recently where the cost of goods accounted for 70% of the expenses, which was extremely high, even for that type of business, the nature of that business. So that straight away sounded the alarms for me in valuing that particular business. And I had to understand why that was the case and whether it's something that affected the value of that business moving forward. So you need to understand what they are and how they measure in relation to how that business is trading. You also have to have a pretty strong understanding of the general operating expenses of that business. How much do those expenses account for in financial terms and also percentage terms? and are they standard in regards to percentages with other types of business that operate in that industry. Also need to be understanding of the trend of all of those items. Gross revenue, cost of goods, gross profit, the gross profit margin, the operating expenses. How have they travelled over the last 3 years in particular? And I mentioned earlier that you need 3 years, I think as a minimum 3 years financials going back on any business. I'd prefer to have 4 or 5 years of financials to give you a really good indication as to how that business has operated over the last few years and whether there are any trends that that are clear to you when examining things like gross revenue, cost of goods, gross profit margins, operating expenses, and of course, net profit or loss before tax. But we'll talk about that in a little bit more detail in the next few slides, because net profit is really the subjective measure of that business, and not really, in a lot of cases, not really a good indication as to how that particular business is trading. But you need to be aware of the level of that they are at the time that you're doing the valuation, and how they've travelled, how they account for the last 3, 4, or 5 years. Are there any trends where there was a spike, or any trends that for some reason there was a lower percentage of that particular item? Now in Australia, when you go back 5 years, of course we cover COVID. And so you will obviously find unusual trends in those last years of COVID, certainly by way of gross revenue. And also in Australia, I'm not sure how other countries dealt with this, but in Australia, the government was giving a lot of money to businesses that qualified, that were suffering with COVID. They obtained a lot of revenue, one-off revenue hits from the government. So you have that income also included in the business financial statement. So very important for you to be aware of that when doing evaluation, when you're looking backwards. Not only the trend of revenue, because most businesses did suffer, but not all businesses. For example, there were many businesses in Australia that flourished over COVID. For example, supermarkets, medical centres, chemists did really good business during COVID. So an important aspect to understand when you're going back 3 or 5 years, what happened to that particular business. Not necessarily important in valuing it in terms of today's level of values, but understanding how that business traded during COVID. And so I mentioned the net profit or loss before tax, why that's not an important matter. I've valued many, many businesses that have had a net loss in their financial statements over the last 3 years. But when you take a closer look at it, they're actually quite healthy and performing quite well. And why is this the case? Because you need to know which items to add back into income. For example, the standard approach when dealing with depreciation of plant and equipment in a business is to add it back. Because what we're trying to do when valuing a business is bring it to a common denominator that we can compare to other types of businesses. And the only way to do that is to add what we classify as include add backs. And these add backs are primarily depreciation, made up of depreciation, the primary working owner's actual and market salary. So it's important to understand that. The owner's superannuation, we also add back into the system, and any other expenses directly incurred by the owners. So now what we're trying to do is normalise or standardise the profit and have a better understanding of that, what that business profit really looks like, and taking into account, as I said, any depreciation, but anything also directly related to the owners of the business, and adding back their salaries and any deductions that they might have. Some of the terms that you need to be aware of, and these are just a few of them that I've added here for this afternoon's presentation. I should have mentioned early on that the time allocated in doing this will just give you a taste of how to undertake a business valuation. But business valuations is something that needs to be studied for years and years and years to be proficient at it. So this just gives you a really superficial view of what you need to be aware of when undertaking a business valuation. So see, these are some of the terms that you need to be mindful of when doing these types of valuations. So EBITDA is the first one, which is earnings before interest, tax, depreciation, amortization after management costs. SDE, seller's discretionary earnings. So when I said earlier, we're adding back some of those expenses that the owner directly had incurred. We're trying to, what we classify as normalizing the business operations by just looking at the bare business and how it operated. Anything to do with the directors or owners of the business, we're going to add back in. EBITDA SDE is defined as the net income before deducting the primary owner's compensation and benefits, other discretionary non-operating or non-recurring income or expenses, depreciation, interest, and taxes. If there is an additional owners working in the business, their compensation needs to be adjusted to market rates. Now, when I say compensation, I'm talking about what they draw as a salary. We want to put that back in. So looking at how the business actually trades without stripping out what the owner's benefits are, the owner of the business. Normalisation is another term, the process of adjusting net profit to accurately reflect real expenses attributable to the operations of the business. So again, when we're trying to value a business, what we're trying to do firstly is get a real sense of how that business is trading and not what the owners of the business are pulling out. So we're trying to standardise that. We're doing that for two reasons, just to get a better handle on how that business is actually trading. And secondly, we want to do a comparison with other types of similar businesses. And we need to do the same thing with them. We need to bring it to a standard level so we can make a comparison. If one business sells for 750,000 and we're valuing our business, which is similar, is our business worth more or less than that amount? And the only way to do that is to examine them on a very similar level. So that's why we strip away and we add back some of these expenses. And the add back term, non-business expenses that are added to net profit as part of the normalisation. So again, we're trying to get a standard level of comparison between some of these businesses before we value them. These are some of the tools that I use in undertaking valuation of businesses. This particular business that I was doing a valuation for, clearly you can see that the revenue for this business is trending downwards. So total revenue is dipping. Why? Normalised EBITDA for this business is also trending upwards. So that's despite total revenue decreasing, the EBITDA is actually increasing. Add backs account for less than 10% of normalised EBITDA, which is positive. So again, the more adjustments that you're making to the business operations in an add backing sense is a negative aspect. So the more money, the more items that the operators are taking out of the business for their personal use, and that could be by way of superannuation, vehicle expenses, any other bonuses that they pay themselves, which you will add back. The less they are of those, then the business is actually trading on a more truer level, because when you have the owners stripping out hundreds of thousands of dollars out of a business, it makes it more difficult to convince a purchaser that the level of net profit is much higher than what's being shown in the financial statement. So the less adjustments you're making in an add back process, the better it is. This particular business had a large increase in profit on the previous years, although the averages may be misleading. So these are just some graphs that I certainly use to give me assistance in valuing different types of businesses. Sometimes they're useful, sometimes they're not, but they're very interesting in giving me a description of where that particular business has some sort of issues. This is, I just wanted to show you an actual situation of how I go about making an adjustment on a particular business. This particular business was trading quite well, and I went back 3 years. Although the gross sales was actually quite positive, although there was a declining level there. So that certainly gave me some questions to ask in relation to this business. The net operating profit was not fantastic because it went from 107,000 to a negative of 39,000 and then back up to 10,000. So on the face of it, when you looked at these figures, you'd say, well, I don't think this particular business is actually operating all that well. But this is where I say it's important to then examine the add backs that we include back into the process. So in this particular case, we're adding back depreciation, the owner's salary, any interest, which is not a great amount, but owner's superannuation. So the more realistic net profit, or what we term as the normalized profit in this particular business, now looks a little bit more healthier, with the current year's, or 2024 rather, was 67,700, 128,000, 177,000. Now, the important thing there is it's much more healthier and is actually making a reasonable profit. That profit, though, has been declining. So in valuing this business, I had to be mindful of that and try and find some comparable evidence that assisted me in putting a reasonable valuation on this specific business based on what other businesses, similar businesses, were selling for. So they're the financials. That's the adjustments that I make. We've got sales, we've got other income, and then we've got less the cost of sales in this particular case. We've got a level of gross profit. And then from that, I take away the total expenses and I'm left with the net operating profit. So those items are stripped straight out of the financial statements for this particular business. So these are audited statements, and that's important aspect is also to ensure that you get audited statements. And so that top half of that spreadsheet simply looks at how the business is trading and what the financial statements show. The bottom half of that spreadsheet then is the add backs that I put back into the business to have a more realistic or normalized approach to what the profit of that business is. And as you can see, it looks a lot more healthier, although the trend still is declining in relation to normalized profit. These are some of the sales of similar type businesses that I was able to research. And is that a question? No, I thought that might have been a question. That's okay. I'll keep going. So in this particular case, I have 7 sales that I was able to research, and the second column, sale price, gives us an indication of what similar type businesses are selling for. The next column is the year that business actually was sold or purchased. The next column was the gross revenue. What's that business trading in relation to gross revenue? The next column is the EBITDA, and the last column is the multiple. Mr. Sopon, was that any questions did you have? Do you want me to wrap it up?
Yes, sir. So that is the presentation from Mr. Gino Mitrione. So, any questions so far? We have around almost 60 people, but now it is around 48 or something. Yes. Any questions so far?
Just before the questions, Dr. Sopon, I'll just finish
Ah,
up
okay.
the last slide, which
Page 78.
this just gives me a summary of how I valued this particular business. So I've used, in this particular case, two methods that I recall: the return method and the market approach. The return method, from comparable sales, we can see that the analysed multiples of EBITDA range from 1.11 to 1.75. In assessing the value of the subject business, I've adopted a multiple of 3 of EBITDA in using this methodology and using the normalised profit weighted over the last 3 years at 50% for 2024, 25% for 2023 and 25% for 2022, which shows a normalised profit of 110,374. Then using a multiple of 3.75 will generate a value of 413,000. So I've valued this particular business at 400,000 odd. The market approach, this method arrived at by multiplying the gross yearly turnover of a business by an accepted market percentage, which results in an estimated market value. When using comparable sales of similar businesses, it can be seen that percentages of market value to be applied from 22% to 138%. A 55 market value percentage has been adopted from the following analysis of the comparable sales. When this percentage is applied to the weighted average over the past 3 years, being 724,000, so this is now a gross figure, the value is 398,000. So for this particular business, I valued at 400,000 using a combination of those two approaches. Thank you, Dr. Sopon.
Yeah, thank you, sir. Okay, so that very comprehensive for us. Can you hear me? Yeah, should be okay.
Yes.
Yeah, okay. So let me see. There are 2 chats here. Any comments so far?
I know that's a lot to take into account all in one sitting, but feel free to ask any
a day
questions.
or 2, but you make it in an hour, a little more than an hour, that's fine. So there might be no question, but for the time being, allow me to introduce to you again at the beginning. Some of you may not be here. Our speaker now is Mr. Gino Mitrione. He is the principal of the Partners Property Advisory and Valuation. Again, the principal of Partners Property Advisory and Valuation, his own firm. But formerly, he has been working for the government in valuation for a long time. He said over 40 years, but really still look very young. And also in Melbourne and also in Victoria, the estate market as well. And he has been expert witness in Supreme Court in Victoria and many other courts, as well as the administrative tribunal. And he is also lecturing at the University of Melbourne and has been lecturing for over 10 years on valuation for students in the university. So that is about Mr. Gino Mitrione. Any questions so far? Did you see any question? There are some chat here. Let me check. Oh, they just praise you. So no question here. So okay.
You've muted yourself, Dr. Sopon. You're on mute.
Sorry, I'm mute. Sorry. Yeah, so if there is no Dr. Chi Ming Yu from Taiwan, do you have any question or any comment so far?
Yeah, hello. Yeah, could you hear me?
Yes, sir.
Okay, so good to see Dr. Sopon, every expert. Glad to meet Gino again. My question is on the message. Yeah, because you mentioned about some multiplier in page 10 and in page 16 and 27, but all different. So what's the difference when you apply this kind of a multiplier? Thank you.
Good to see you again. Hope you're doing well. So,
Mr. Audi from USA, Mr. Audi Brady from Florida. Any comments so far, sir?
Florida. Yes, good afternoon and good morning for me here, okay, in
Yeah,
Florida.
you're 5 o'clock in the morning,
And,
I think.
Yes, we are like 6:16 in the morning. It is
Oh,
an
God.
excellent presentation, Mr. Gino, and I really enjoy it. Okay, I would like to know, I put that question on the chat, how difficult it is in Australia, okay, to establish the market value of a business like the subject, okay, when there is no comparable approach.
I suppose it's the same way it is difficult to value property without any comparable sales. Almost impossible because you're making no comparison. You need a comparison to make a determination as to the level of value of any asset, whether it's a business or real estate. But to answer your question, if there are no comparable sales, then you need to find the next best thing to a comparable sale. So if you can't find a comparable sale, what's something similar that you can use? Because you need some evidence. It is almost impossible to value any property or business without some level of sales evidence. So if you can't find anything comparable, then you need to find something that's less comparable, but not so much that it's entirely different. So you need some level of evidence to value anything, or else you're just plucking a figure out of the air, which is not valuations. It's just not to denigrate real estate agents at all, but you're then acting more as a real estate agent rather than a valuer. And you need evidence to determine your opinion, because otherwise, what are you basing your opinion on?
Yeah.
But I
Another
understand
thing
in
is,
some case.
yes. Another thing is, if there is really no information at all, perhaps what we can do is we can see the performance of that business, say during the 3 years period or 5 year period. If it is something like stable, or we can see what are happening, we can use that net profit or something to calculate for our business value. But we have, like in real estate valuation, as Mr. Gino said, we also have to know the safe rate and also the risk. Say if your net profit for 5 years or 10 years is really fluctuate, it means that the risk premium may be really high. So maybe the multipliers for the net profit on the average may be say 2.5 times or 3 times or something, depending on the fluctuation of the business. And also the future, as you may know, if like in the case of tailor, you are doing the tailor the suit or something, this business may be run down because people will just buy jacket or buy the shirt from supermarket. They have no need to go to the tailor anymore or something. So some rundown business, the years of operation or the future will be really short, maybe less than 10 years. So in this case, the capitalization rate or discount rate may be really high, that make your value maybe really low. That may be something we can compensate if we don't have any information at all. But I think in your country, in the US or Australia, there should be a lot more information compared to in the case of Thailand or something. So this is some thing about the valuation. Okay, so I think we should end this session that is very knowledgeable and informative from our speaker, Mr. Gino Mitrione. So let's give a big hand to Mr. Gino. And next month we will have again our webinar. I will announce to you soon. So thank you today for Mr. Gino, Mitrione, and all our participants here. Mr. Audi from Florida, very early in the morning. Thank you very much indeed, and sorry for this time. So see you again. Bye bye. Take care, everyone.
Thank you. Bye bye.
Good day, mate.
Bye.
Bye bye.
Thank you.